Before we dive in, please remember, I am not a financial advisor, and this video is for educational and informational purposes only. All investing involves risk, and you should always do your own research and consult with a licensed professional before making any financial decisions. You work hard, you put in the hours, you get the paycheck, and you try to save what you can, but you look at your savings account and the number just isn't moving. It feels like you're running on a treadmill, putting in all the effort but going nowhere. While you hear whispers about other people building real wealth, getting ahead, and creating financial freedom, they talk about the market, about stocks, about investing, and it sounds like a secret language, a private club for the rich that you were never invited to. What if I told you that club isn't exclusive, that the language isn't that hard to learn, and that the single biggest difference between staying on that treadmill and building a different future is simply understanding what we're going to talk about right now? Imagine two friends, let's call them Alex and Ben. They graduate from the same school, get similar jobs, and earn the exact same salary. Both are smart, both are diligent savers. Every month, Alex takes $200 and puts it into a high-yield savings account. It's safe, it's secure, he can see the money. Ben also takes $200, but he does something different. He learns the basics of the US stock market and invests that money into a simple fund that tracks the overall market. For the first few years, there's not much difference. Alex's account grows slowly and steadily. Ben's account goes up and down, and sometimes it's even worth less than what he put in. Alex feels smug. Ben feels nervous, but he sticks with it. Now let's fast forward 30 years. Alex logs into his bank account. He's proud. Through consistent saving, he has a nest egg of $75,000. Not bad at all. Then Ben logs into his account. His $200 a month, through the power of the American economy and compound growth, has turned into over $400,000. Same effort, same money saved, a completely different life. That is not a fantasy. That is the mathematical power of the US stock market. And the wall of jargon and complexity that has kept you from accessing that power? We are going to demolish it together brick by brick over the next 10 parts. By the end of this series, you will not only understand what the stock market is, you will understand how it works, and you will have the foundational knowledge to start your own journey, transforming from a passive saver into a confident investor. So let's start with the absolute most fundamental question. What even is a stock? Forget Wall Street. Forget the confusing charts and the guys in suits yelling on TV. I want you to picture your favorite local coffee shop. Let's say it's called The Daily Grind. The owner did an amazing job. The coffee is fantastic, the service is great, and there's a line out the door every single morning. The owner wants to expand, to open a second, a third, maybe 100 locations. But that takes a lot of money she doesn't have. So, she decides to sell off tiny little pieces of her company to raise that money. Each tiny piece is called a share of stock. When you buy a share of The Daily Grind, you are not just a customer anymore. You are now a part owner. You literally own a small fraction of the entire business. If the business does well, opens new stores, and makes more profit, your little piece of ownership becomes more valuable. If the business does poorly, your piece becomes less valuable. That's it. That's all a stock is. It's a certificate of ownership in a real-life business. When you hear that someone bought a share of Apple, it means they bought a microscopic slice of the company that makes your iPhone. When they buy a share of Ford, they own a tiny piece of the factories that build F-150s. You are not betting on a random number on a screen. You are investing in the future success of an actual, tangible company. Okay, so a stock is a piece of a company. Simple enough. So what then is the stock market? Well, where do you go to buy Apples or Ford trucks? You go to a market, right? A grocery store or a dealership. The stock market is the exact same thing. It's not a mysterious physical place anymore, for the most part. It's a massive global digital marketplace where all those tiny pieces of ownership, all those shares, are bought and sold every second of every business day. Think of it like eBay or Amazon. If you want to buy a share of Apple, you don't have to track down an existing Apple shareholder and negotiate a price. You just log onto a platform, see the current going price that millions of other buyers and sellers have agreed on, and you click buy. The stock market is the ultimate middleman. It connects the person who wants to sell their piece of the coffee shop with you, the person who believes in that coffee shop and wants to buy a piece. It's a gigantic, efficient auction house for slices of the biggest and best companies in the world. This is where the light bulb moment happens for most people. This isn't gambling. This isn't some abstract concept. This is about connecting your money to the engine of the American economy. Every time you buy a Coke, use Google to search for something, or order a package from Amazon, you are interacting with publicly traded companies. Investing in the stock market is simply your way of saying, I believe these companies, and the American economy as a whole, will continue to grow and be more valuable in the future than they are today. You are shifting from being just a consumer of their products to being an owner of their success. And that is why this matters to you. Because for 99% of us, our regular job, our salary, will not be enough to achieve true financial freedom. Pays the bills, it puts food on the table, but it's a linear equation. You trade your time for money. The stock market allows your money to start working for you. It allows your savings to have a job of their own, working 24/7 to grow and compound, creating a second stream of income that isn't dependent on you clocking in. This is the tool that can help you pay for your kids' college, retire with dignity, and sleep soundly at night knowing your financial future is secure. Now, in the United States, when people talk about the market, they are usually talking about two major marketplaces, two giant stock exchanges. You've definitely heard their names, the New York Stock Exchange or the NYSE and the NASDAQ. The New York Stock Exchange is the old guard. It's the one you see in movies with the big grand building on Wall Street. It was founded over 200 years ago under a buttonwood tree. It's home to many of the oldest, largest, most established blue-chip companies in America. Think Coca-Cola, Walmart, Johnson & Johnson. It used to be all about people on a trading floor yelling at each other, but even the NYSE is largely electronic today. Then you have the NASDAQ. The NASDAQ is the new kid on the block, relatively speaking. It was founded in 1971 as the world's first ever electronic stock market. There is no physical trading floor. It's all digital. And because of that, it became the natural home for the most innovative technology companies in the world. When you think of the NASDAQ, you think of Apple, Microsoft, Google, Amazon, and Tesla. It's the hub for technology and high-growth companies. So, you have the established giants on the NYSE and the tech-savvy innovators on the NASDAQ. Together, they form the heart of the U.S. stock market, the primary arenas where these shares of American enterprise are traded. So let's recap. We've torn down the first wall. You now know that a stock is just a small piece of ownership in a real company. You know the stock market is simply the marketplace where those pieces are bought and sold. And you know the two main marketplaces in the US are the NYSE and the NASDAQ. You are already ahead of 90% of the population. But this leads to the next, most crucial question. We know what a stock is, but how does it get its price? Why is one share of a company worth $10 and another worth $1,000? And more importantly, what makes that price shoot up or crash down in a single day? Understanding that is the key to everything. It's a two-word answer that governs almost everything you buy, from a gallon of gas to a Taylor Swift concert ticket: supply and demand. But in the stock market, this simple concept is on steroids, supercharged with human emotion, global events, and high-speed technology. Let's forget about stocks for a minute. Imagine a brand new video game console is released, the Hypersphere 9000. The company that makes it, let's call them Genesis Games, decides to sell it for $500. That's its initial price. Now Genesis Games is smart. They only release 1 million consoles in their first run. That's the supply. It's fixed. There are only 1 million Hypersphere 9000s in the entire world. But then something happens. A famous streamer gets one early and calls it the greatest console ever made. Tech reviews are flawless. Suddenly everyone wants one. 10 million people are desperately trying to buy a console that only has a 1 million unit supply. That's the demand. What happens to the price? Well, the official price is still $500, but you can't get one. They're sold out everywhere. So, you go to a secondary marketplace like eBay, and there you see it. People who were lucky enough to buy a Hypersphere 9000 for $500 are now selling it for $1,000. A few days later, it's $1,500. People are paying triple the original price. Why? Because the value isn't determined by what Genesis Games said it was worth. The value is determined by what someone else is willing to pay for it right now. The price is simply the meeting point between the limited supply and the overwhelming demand. That is the stock market in a nutshell. A share of a company's stock is just like that Hypersphere 9000. There is a fixed number of shares available. That's the supply. The people who want to buy those shares create the demand. The place where they meet to argue over the price isn't eBay. It's a stock exchange like the New York Stock Exchange or the NASDAQ. And every single second the market is open, millions of buyers and sellers are placing their bids, constantly negotiating what that share is worth. The price you see on your screen, that constantly flickering green or red number, is simply the price of the very last trade that happened. The most recent agreement between one buyer and one seller. So if that's the how, the much more important question is the why. Why does demand for a stock suddenly explode, sending its price soaring? And why does it sometimes collapse, causing the price to crash? It boils down to a few key forces. First, and most obviously, is the company's performance. Is Genesis Games actually selling a ton of consoles and making a mountain of cash? When a company reports its earnings every 3 months, it's like a report card for the whole world to see. If they announce they made way more money than anyone expected, what Wall Street calls an earnings beat, it's a powerful signal. It tells investors, this company is healthy, it's growing, it's a winner. Demand for the stock goes up. More people want to own a piece of that success and the price rises. Conversely, if they announce they lost money or sold fewer products than expected, investors get spooked. They rush to sell their shares before the price drops even further. Demand dries up, supply floods the market, and the price falls. But here's where it gets more interesting. The stock market doesn't just look at what a company is doing today. It's obsessed with what it might do tomorrow. This is the power of future growth potential. Imagine you hear a rumor that Genesis Games has a secret project, a revolutionary virtual reality headset that's 10 years ahead of its time. It's not out yet. They haven't made a single dollar from it. But the idea of it, the potential for it to change the world and generate billions in future profit, is intoxicating. Investors will start buying the stock now, betting on that future success. They are willing to pay a higher price today because they believe it will be worth even more in 5 years. This is why you see some tech companies with sky-high stock prices, even if they aren't hugely profitable yet. The price is based on a dream of the future. The third driver is the big picture. The overall economy. Think of the economy as the weather. It affects everyone. If the sun is shining, meaning unemployment is low, wages are rising, and people feel confident, they have more money to spend and invest. They're more willing to buy stocks, pushing prices up across the board. But if a storm is brewing, like a recession, high inflation, or rising interest rates, people get scared. They pull their money out of the market and put it into safer places. This widespread selling can drag down the prices of even great, healthy companies. It wasn't that the company did anything wrong. It's just that it started raining on everyone. And finally, there's the most unpredictable driver of all: human emotion. The stock market is not a perfect logical machine. It's a collection of millions of human beings, driven by the two most powerful forces in finance: greed and fear. Sometimes a stock's price goes up simply because it's going up. People see a stock rising, they get a fear of missing out, FOMO, and they jump in, which pushes the price even higher. This creates a feedback loop, a wave of pure momentum, often detached from the company's actual performance. It's a story, a vibe, a collective belief. This is the world of hype and sentiment. The opposite is also true. A wave of fear or panic can cause people to sell indiscriminately, crashing a stock's price far below what it's logically worth, based purely on a bad feeling. So these four forces: performance, future potential, the economy, and human emotion, are constantly pushing and pulling on the demand for a stock, causing its price to dance. Now, this brings us back to one of the most common points of confusion for beginners. Why is one share of company A worth $1,000, while a share of company B is only $10? Does that mean company A is 100 times better? Absolutely not. And understanding this is one of the most important lessons you will ever learn. The price of a single share by itself is almost meaningless. Let me explain with the pizza. Imagine you have two pizzas. The first one is a massive party-sized pizza. It's worth $1,000, but it's cut into only 2 gigantic slices. Each slice therefore costs $500. The second pizza is a small personal-sized pizza. It's only worth $10, but it's been cut into 100 tiny bite-sized pieces. Each piece therefore only costs 10 cents. If I offer you one slice of the first pizza for $500, or one piece of the second pizza for 10 cents, which one is more expensive? The slice, of course. But which pizza is more valuable? The $1,000 one. The price per slice doesn't tell you the value of the whole pizza. Stocks are the exact same way. The share price is just the price of one slice. To know the true value of the whole company, you need to know two things: the price of a single share and how many total shares exist. When you multiply the share price by the total number of shares, you get a number called the market capitalization, or market cap for short. That number represents the total value of the company on the stock market. It's the price to buy the whole pizza. So, a company with $1,000 stock price, but only 100,000 shares in existence has a market cap of $100 million. But a company with a $10 stock price that has 50 million shares in existence has a market cap of $500 million. Even though its share price is way lower, the $10 company is actually 5 times bigger and more valuable than the $1,000 company. So never, ever judge a company based on its share price alone. It's one of the most common rookie mistakes. Always look at the market cap. So we have the buyers, the sellers, and the stocks themselves, all priced by the chaotic forces of supply and demand. But where do they all meet? What is this giant digital marketplace called the New York Stock Exchange or the NASDAQ? It's not just a building in New York with a bell. It's a complex, high-speed system with its own rules, its own language, and its own secrets. And understanding how that system works is the next critical piece of the puzzle. So let's pull back the curtain on that system. Forget the frantic shouting and flying paper you see in old movies. The modern stock exchange is less of a chaotic trading floor and more of a sophisticated, high-speed digital marketplace. But to really understand it, let's use a simpler analogy. Imagine the biggest, most popular farmers market in the entire world. In this market, you have thousands of farmers. These farmers are the companies Apple, Ford, Coca-Cola. Instead of selling apples or corn, they're selling tiny pieces of their farm, tiny slices of ownership. These are their stocks. On the other side, you have millions of shoppers. That's you, me, and everyone else who wants to buy. We are the investors. Now this farmers market is so massive that it needs a manager, an organizer, to make sure everything runs smoothly. That organizer is the stock exchange, like the New York Stock Exchange, the NYSE, or the NASDAQ. The exchange doesn't own the farms and it doesn't own the produce. Its job is incredibly important. It sets up the stalls, makes sure the rules are followed, and most critically, it provides a central place where buyers and sellers can find each other and agree on a price. This is the absolute core function of an exchange, to facilitate price discovery. Think about it. If you wanted to buy a share of Microsoft, how would you find someone willing to sell it? Would you post an ad on Craigslist? Shout on a street corner? Of course not. You go to the market, the exchange, where millions of buyers and sellers are gathered. And this is where it gets fascinating. How is the price of a stock actually set? It's not a sticker price like at a grocery store. It's a constant live-action negotiation happening millions of times per second. It all comes down to 2 little words: the bid and the ask. Let's go back to our farmer's market. A shopper, a buyer, walks up to a stall and says, "I'm willing to bid $1 for one of your apples." At the same time, the farmer, the seller, says, "I'm willing to ask for $1.05 for my apple." Right now there's no deal. The buyer's bid is too low, and the seller's ask is too high. The gap between those two numbers, that 5-cent difference, is called the bid-ask spread. This spread is the lifeblood of the market. A trade, a transaction, only happens when the bid and the ask meet. Either a buyer raises their bid to meet the asking price, or a seller lowers their asking price to meet the bid. Now, multiply that simple negotiation by millions of people and billions of dollars, all happening at the speed of light through fiber optic cables. That is the modern stock market. The price you see quoted for a stock is simply the price of the very last transaction, the last time a buyer and seller agreed on a price and made a trade. This is why news can change a stock's price so quickly. If a medical company announces a breakthrough drug, suddenly thousands of new buyers rush into the market, all bidding higher and higher to get a piece of the action. The sellers see this demand and raise their asking prices. The price skyrockets. Conversely, if a company announces terrible earnings, sellers rush to get out, lowering their asking prices to find any available buyers, and the price plummets. It's pure, unadulterated supply and demand on a global scale. So we have this massive digital marketplace. But what's the real difference between the two big ones in the US, the NYSE and the NASDAQ? Think of the New York Stock Exchange, the NYSE, as the old prestigious club. It's the big board. Founded in 1792 under a buttonwood tree on Wall Street, it has a certain gravitas. Historically, it operated as an auction market. On its physical trading floor, you had specialists, now called designated market makers, whose job was to manage the trading of specific stocks. They were human beings responsible for matching buyers and sellers and maintaining a fair and orderly market. While most trading is electronic now, that human element and the physical floor still exist, giving it a unique hybrid model. The listing requirements for the NYSE are also incredibly strict, which is why it's home to many of the world's oldest, largest, and most established blue-chip companies. Then you have the NASDAQ. It's the younger, tech-savvy upstart. Founded in 1971, it was the world's first electronic stock market. It never had a physical trading floor. From day one, it was a network of computers. The NASDAQ operates as a dealer's market. Instead of one specialist, multiple dealers or market makers compete to post the best bid and ask prices for a stock. This competition is what drives the price. Because of its electronic nature and slightly more accommodating listing requirements, it became the natural home for innovative technology companies. Think Apple, Amazon, Google, Microsoft. They all live on the NASDAQ. One isn't inherently better than the other. They are just two different systems, two different models for achieving the same goal: connecting buyers and sellers efficiently. Now, any market with this much money flying around needs a referee. It needs a set of rules and an enforcer to make sure nobody is cheating. In the United States, that referee is the SEC, the Securities and Exchange Commission. The SEC is a government agency with a three-part mission: to protect investors, to maintain fair, orderly, and efficient markets, and to facilitate capital formation. In our farmers market analogy, the SEC is the market manager who inspects the scales to make sure they're not rigged, checks the farmers produce to make sure they're not selling rotten fruit, and watches the crowd to make sure no one is picking pockets. They require public companies to disclose meaningful financial information, so you, the investor, can make informed decisions. They crack down on fraud, insider trading, and any kind of market manipulation. The SEC's existence is one of the core reasons people have confidence in the U.S. stock market. It provides a foundation of trust. So we have the market, the exchanges, and the referee, the SEC. The final piece of this puzzle is you. How do you actually place an order to buy a stock? You don't call up the NYSE yourself. You do it through your broker, and you generally have two basic ways to tell them what to do: a market order and a limit order. Understanding the difference is not just technical, it's strategic. A market order is the simplest. It's you saying, I want to buy 10 shares of this company right now at the best available price. You are prioritizing speed. You are virtually guaranteed to have your order filled almost instantly. The downside: you don't have control over the price. If the stock price is moving quickly, the price you actually pay might be slightly higher than the price you saw on your screen a second ago. It's like telling your friend to run into the farmer's market and buy the first bag of apples he sees, no matter the cost. You'll get your apples, but you might overpay. A limit order, on the other hand, gives you control. It's you saying, I want to buy 10 shares of this company, but I am only willing to pay a maximum of $50 per share. You set your price, your limit. Your order will only execute if the stock's price drops to $50 or lower. This protects you from paying more than you're comfortable with. The downside: there's no guarantee your order will ever be filled. If the stock price never drops to your limit, you'll be left on the sidelines, and you might miss out on a potential gain. It's like telling your friend, only buy those apples if you can get them for $1 a pound. You control the price, but you might come home empty-handed. These two order types represent the fundamental trade-off every investor faces: speed versus price. Do you want in now, or do you want in at the right price? There is no single right answer. It depends entirely on your strategy and your goals. So we've walked through the doors of the marketplace. We understand that the exchanges are the grand organizers, connecting buyers and sellers to discover a price through bids and asks. We know the difference between the historic NYSE and the digital NASDAQ. We know the SEC is the cop on the beat, keeping the game fair. And we know the basic commands we can give our broker to enter the game ourselves. We've explored the market's architecture, the very plumbing of how it all works. But a building is nothing without what's inside it. We now know how to buy a stock, but that leaves the most important question of all. What stock should we buy? How do you tell a giant stable blue-chip company from a small risky startup? How do you read the blueprints of a business before you decide to own a piece of it? That is the art and science of picking investments, and that's exactly where we're going next. The first and most fundamental way we do this is by looking at a company's size. In the world of stocks, size isn't measured by the number of employees or how many buildings they own. It's measured by something called market capitalization, or market cap for short. Now, that might sound like a complicated Wall Street term, but the idea is incredibly simple. Imagine a company has 1 million shares of its stock out in the world. And today, each one of those shares is trading for $50. To get the market cap, you just multiply those two numbers. 1 million shares times $50 per share gives you a market cap of $50 million. That's it. That's the total dollar value of the company according to the stock market. It's the price tag you'd have to pay to buy every single piece of that company. Think of the stock market like a giant shopping mall. You've got the massive sprawling anchor stores that have been there for decades. You've got the medium-sized, popular brand stores in the main corridors. And you've got the tiny brand new kiosks and pop-up shops. Market cap is just a way of sorting companies into these different sized stores. Generally, we break them down into three main categories. First, you have the giants. These are the large cap stocks, often called blue chips. Think of companies you use and see every single day. Apple, Microsoft, Amazon, Coca-Cola, Johnson & Johnson. These are the battleships of the economy. They are enormous, with market caps in the hundreds of billions or even trillions of dollars. They move slowly and steadily. They're not going to double in price overnight, but they're also very, very hard to sink. Because of their stability and massive cash flow, these are often the companies that pay out a portion of their profits to shareholders, which, as we learned, is called a dividend. They are the bedrock of many long-term investment portfolios. Next, you have the mid-cap stocks. These aren't household names to the same degree as the blue chips, but they are often very successful established companies. Think of them as the speedboats to the large-cap battleships. They're smaller, more nimble, and have more room to grow and accelerate faster than the giants. They might be a popular regional bank, a successful software company that businesses use, or a well-known clothing brand that isn't quite a global behemoth yet. They offer a blend of the stability of larger companies with the growth potential of smaller ones. It's a sweet spot for many investors, but they do carry a bit more risk than the battleships. Finally, we have the small-cap stocks. These are the jet skis of the market. They are small, fast, and incredibly agile. This is where you'll find newer companies, startups, and businesses in emerging industries. Their potential for growth is immense. A small-cap stock has a much better chance of doubling or tripling in value in a short period than a giant like Microsoft. But they can also flip over and sink in a flash. For every small company that becomes the next Amazon, thousands of others fail. This is the high-risk, high-potential reward section of the market. It's exciting, it's volatile, and it's where you have to be most careful. So, right away, just by knowing if a company is a large cap, mid cap, or small cap, you already know a huge amount about its general personality, its potential for risk, and its potential for growth. But size is only one part of the story. The other critical piece is the company's strategy, its philosophy. Are they trying to aggressively take over the world, or are they focused on being a steady, profitable workhorse? This leads us to the two fundamental styles of investing: growth and value. Let's start with growth. A growth stock belongs to a company whose main goal is to expand as quickly as possible. These companies are in a race. They take every dollar of profit they make and plow it right back into the business. They're hiring more people, building new factories, spending massively on marketing, and expanding into new countries. Think of a growth company like a teenager during a massive growth spurt. They are consuming everything in sight, all the cash, all the resources to get bigger, stronger, and faster. They're not interested in giving you an allowance or a dividend. They're using that money to buy new shoes because they just outgrew their old pair. Technology companies are the classic example. Think about Tesla or Amazon in its early days. Their stock prices weren't high because they were making huge profits at the time. They were high because investors believed in their vision for explosive future growth. People who buy growth stocks are betting on that future. They are willing to pay a premium price today for a company that they believe will be much, much larger tomorrow. The ride can be a roller coaster with big ups and big downs, but the potential payoff can be life-changing. On the other side of the coin, you have value stocks. A value stock is almost the complete opposite. These are typically well-established companies, often large-cap blue chips, that are no longer in that explosive growth phase. They are already big. They have a stable business, a loyal customer base, and consistent, predictable profits. Think of value investing like finding a high-quality, brand-name winter coat at a thrift store for $20. You know it's worth way more, but for whatever reason, the market is overlooking it. It's on sale. Value investors are bargain hunters. They are looking for solid, dependable companies that the market has temporarily undervalued. The father of value investing, Benjamin Graham, and his most famous student, Warren Buffett, built their fortunes on this philosophy. They look for great businesses selling at a fair price. These companies aren't trying to be flashy. They are the workhorses. Think of utility companies, big banks, or consumer goods companies like Procter & Gamble, the makers of Tide and Crest. People will always need electricity, banking, and toothpaste. These companies tend to grow slowly but surely, and because they aren't reinvesting every single penny into frantic growth, they often have plenty of cash left over to pay out to their shareholders as dividends. Now here's the key. These categories, size and style, can be mixed and matched. You can have a large-cap growth stock like Microsoft, which is a giant that is still growing at a rapid pace. You can have a large-cap value stock like Coca-Cola, a stable giant that pays a reliable dividend. You can have a small-cap growth stock like a new biotech firm with a promising drug in trials. And you can even have a small-cap value stock, maybe a small, forgotten local manufacturing company that's trading for less than its assets are worth. Understanding this simple framework, large, mid, small, and growth versus value, is like being handed a map. The next time you hear about a stock on the news, you can immediately start to place it on this map, giving you instant context about what kind of investment it is. Okay, so we know how to categorize a company, but how do you actually find it? How do you look it up? You do it using its ticker symbol. A ticker symbol is simply a unique code, usually a set of 1 to 5 letters, that identifies a company on a stock exchange. It's like a license plate for a stock. Apple's ticker is AAPL. Microsoft is MSFT. Ford Motor Company is just F. Google's parent company, Alphabet, is JOGL. This is the language of the market. When you want to check a stock's price, you don't type the whole company name into a financial website or your brokerage app. You type in the ticker. And when you do, you'll see what's called a stock quote. It might look like a wall of numbers, but the most important pieces are easy to understand. You'll see the ticker symbol, the company name, and then the current price, the price at which a single share is being bought and sold right now. You'll also see the change for the day, shown in both dollars and percentage, and whether it's up, usually shown in green, or down, usually in red. This tells you the stock's performance in the most recent trading session. It's a real-time snapshot of the market's mood toward that specific company. So now you have the power to not only understand the basic categories of stocks, but to actually look them up and see their real-time price in the market. You can start to see the difference between a $10 stock and a $1,000 stock. You can see how a small-cap stock might jump 10% in a day, while a large-cap blue chip might barely move 1%. You're starting to speak the language. But knowing a company's size, its style, and its current price is just the surface. It's like knowing the make, model, and sticker price of a car. It doesn't tell you what's under the hood. Is the engine sound? Is the company actually making money? Or is it drowning in debt? How do you determine if that sticker price is a bargain or a total ripoff? To answer that, we have to learn how to look at a company's report card, its financial health. And that means understanding a few simple, but powerful numbers that tell the true story of a business. So, you're standing in the stock market supermarket, looking at a company. You see the price tag. But how do you know if that price is a steal or a highway robbery? You need to look past the hype and become a financial detective. Your first clues are found in a company's financial statements, but don't worry. You don't need an accounting degree. You just need to know what to look for. Let's start with the big, flashy number everyone talks about: revenue. Think of a massive, nationwide coffee chain. Revenue is the total amount of money that flows into their cash registers from selling every single latte, muffin, and bag of coffee beans across the entire country for a year. It's the top line of their financial report card. When you hear a company made billions in sales, they're talking about revenue. It's a measure of scale. A company with 10 billion in revenue is obviously a much bigger operation than one with 10 million. More revenue is generally good. It means people are buying what the company is selling. But here's the critical mistake most beginners make. They stop there. They see a giant revenue number and think, wow, this company must be rolling in it. But revenue is only half the story. It tells you what came in the front door, but it tells you nothing about what went out the back. Imagine you and a friend both open lemonade stands. On your first day, you sell $100 worth of lemonade. Your revenue is $100. Your friend also sells $100 worth. On the surface, you both did equally well. But what if I told you that you spent $95 on organic lemons, artisanal sugar, and a fancy stand? After all your costs, you're left with only $5 in your pocket. Meanwhile, your friend was savvier. They spent only $20 on their supplies. So, at the end of the day, they have $80 in their pocket. You both had the same revenue, but your friend's business is a wild success, and yours is barely surviving. That money left over after all the costs are paid, the cost of lemons, the salaries of employees, the rent for the stores, the taxes, that's the magic number. It's called net income, or more commonly earnings. It's the bottom line. Revenue is vanity. Profit is sanity. When you're looking at a company, you have to ask, after they've paid for everything and everyone, how much is actually left? That's the true measure of a business's success. A company can have billions in revenue, but if it's spending even more to generate that revenue, it's a sinking ship. You want to invest in the profitable lemonade stand, not the one that just looks busy. So now we have two crucial pieces of the puzzle. Revenue tells us how big the business is, and net income or earnings tells us how profitable it is. But there's still a problem. Let's say a giant company like Megacorp makes $10 billion in profit, and a smaller up-and-coming company, Innovate Incorporated, makes $1 billion in profit. Obviously, Megacorp is more profitable, right? Well, not so fast. What if Megacorp is a massive, sprawling empire with a billion shares of stock out there, while Innovate Incorporated is a leaner company with only 50 million shares? We need a way to level the playing field. That's where our next clue comes in: earnings per share, or EPS. This sounds complicated, but the idea is incredibly simple. You take the company's total profit, that net income we just talked about, and you divide it by the total number of shares. It's like taking the entire profit pie and cutting it into slices, one for each share. EPS tells you how much profit is attributable to a single slice, a single share of stock. In our example, Megacorp's $10 billion in profit divided by 1 billion shares gives you an EPS of $10. Each share represents $10 of profit. But look at Innovate Incorporated. Their $1 billion in profit divided by 50 million shares gives you an EPS of $20. Suddenly the picture flips. On a per-share basis, the smaller company is actually twice as profitable for its owners. This is a powerful concept. It lets you compare the profitability of an apple and an orange, or in this case, a giant established company and a smaller, faster-growing one. When you see a company consistently growing its EPS year after year, that's a fantastic sign. It means the business isn't just getting bigger, it's getting more profitable for each individual owner. Okay, detective. You've uncovered the revenue, you've found the real profit, and you've calculated the profit per share. You're getting close to solving the case. But now we have to connect all of this back to the one thing we started with, the stock price. This is the final and most important step for a beginner. It's a metric called the price-to-earnings ratio, or the PE ratio. And it's the bridge that connects a company's performance to its price tag in the market. The PE ratio answers one simple question: how much is the market willing to pay today for every $1 of a company's earnings? The calculation is exactly what it sounds like. You take the stock's current price and divide it by its earnings per share, EPS. Let's go back to our companies. Let's say Megacorp stock is trading at $200 a share. We know its EPS is $10. So 200 divided by 10 gives us a PE ratio of 20. This means investors are willing to pay $20 for every $1 of Megacorp's current earnings. Now let's look at Innovate Incorporated. Its stock is trading at $300 a share. That's more expensive than Megacorp. But remember, its EPS was a whopping $20. So we take its price of $300, divide it by its EPS of 20, and we get a PE ratio of 15. This is a revelation. Even though Innovate Incorporated's stock price is higher, its PE ratio is lower. Based on this one metric, it's actually cheaper relative to its profits. You're only paying $15 for every $1 of its earnings, compared to $20 for Megacorp. Think of it like buying a house. You see two houses for sale. House A costs $500,000, and House B costs $600,000. At first glance, House A is cheaper, but then you look closer. House A is a tiny one-bedroom condo, while House B is a sprawling four-bedroom family home. The PE ratio is like the price per square foot. It gives you a standardized way to compare value. House B, while more expensive overall, might be a much better deal on a per square foot basis. The PE ratio gives you context. A stock price of $500 means nothing on its own. Is it expensive? Is it cheap? You have no idea. But if you know its EPS is $50, you can calculate a PE ratio of 10. Now you have something to work with. So what's a good PE ratio? There's no single magic number. A low PE ratio, say under 15, might suggest a company is a bargain, a hidden gem that the market is overlooking. Or it could mean the company is in trouble, and investors don't expect it to grow much in the future. so they aren't willing to pay a premium. A high PE ratio, say over 30, often means investors are very optimistic. They expect the company's earnings to grow so rapidly in the future that they're willing to pay a huge premium for those earnings today. This is common for exciting tech companies, but it also carries risk. If that spectacular growth doesn't happen, the stock price can come crashing down. The PE ratio isn't a crystal ball. It's a starting point. It's a powerful tool that helps you screen out the obviously overpriced and identify potentially undervalued companies. It forces you to stop looking at just the price and start looking at the value you're getting for that price. By understanding these few numbers, revenue for size, net income for profitability, EPS for per share performance, and the PE ratio for valuation, you've just leapfrogged 90% of beginner investors. You're no longer just guessing or following headlines. You're now equipped with the fundamental tools to look under the hood of a business and make an informed judgment about its health and its price. You can now look at a single company and determine if its stock price seems reasonable or totally out of whack. But a company doesn't exist in a vacuum. It exists in a competitive world, surrounded by rivals fighting for the same customers. So, how does our company stack up against the competition? And what happens when the entire market, the good, the bad, and the ugly, all goes on a massive sale at the same time? That's where you find the real opportunities, and that's exactly where we're going next. So let's talk about these market-wide sales, because they happen, and when they do, it feels less like a fun shopping trip and more like the sky is falling. News channels flash screaming red banners. Experts on TV use words like bloodbath and carnage. Your portfolio, that little number on the screen you were so proud of, suddenly looks like it went 10 rounds with a heavyweight champion. And your gut, your very human instinct, screams one thing: get out. Sell everything. Stop the bleeding before it gets worse. This single moment, this reaction to fear, is the great dividing line between investors who build wealth and those who destroy it. First, let's put some names to these scary events, because they're not all the same. The mildest version is a correction. This is when the market drops by at least 10% from its recent high. Think of it as the market taking a breather, shaking out some of the excess. They're surprisingly common, happening about once every year or two on average. Most of the time, they're over in a few months and the market continues on its way up. Then you have the big one, a bear market. This is a more severe and prolonged downturn, defined as a drop of 20% or more. This isn't just a breather. This is the market getting seriously sick. Bear markets are driven by widespread economic pessimism, fears of a recession, high unemployment, geopolitical crises. They're emotionally draining and can last for many months, sometimes even years. And finally, you have the crash. A crash is a sudden, severe, and often unexpected drop in stock prices in a single day or a few days. Think of Black Monday in 1987, when the market fell over 22% in one session. A crash is pure, unfiltered panic. It can trigger a bear market, but the defining feature is its terrifying speed. Now, why is understanding these terms so important? Because what you call it changes how you feel about it. A sale sounds like an opportunity. A crash sounds like a disaster. But financially, they can be the exact same thing. The price of assets has gone down. Let's travel back in time to late 2008. The global financial system is on the brink of collapse. The news is apocalyptic. Let's imagine two new investors, both with $10,000 invested in a simple S&P 500 index fund. Our first investor, we'll call him Panic Pete, watches the news every night. He sees his $10,000 shrink to $9,000, then $8,000, then $7,000. His friends are talking about putting their money under the mattress. The experts are predicting another Great Depression. The fear becomes unbearable. He finally sells everything he has, taking a $3,000 loss. He tells himself, "Phew, at least I didn't lose it all. I'll get back in when things look safer." Our second investor, we'll call her Steady Sarah, is also scared. She's human. Seeing her hard-earned money vanish is painful, but she remembers the one rule she set for herself. She's in this for the long term, for retirement in 30 years. She doesn't sell. In fact, she has a little extra cash coming in from her paycheck each month, so she continues to invest her regular $200, just as she planned. She forces herself to ignore the daily noise and trusts the historical data that says markets eventually recover. What happens next? Panic Pete, who sold, now has a new problem. When is it safe to get back in? In early 2009, the market is still rocky. Is this the bottom? Or is there another crash coming? He waits. By 2010, the market has recovered significantly. but the headlines are still full of uncertainty. Pete thinks, "Oh, I missed the big bounce. It's too expensive now, I'll wait for another dip." He's paralyzed by the fear of making another mistake. Meanwhile, Steady Sarah's portfolio is healing. Her original investment is climbing back toward its starting point. But something magical has been happening with those little $200 investments she made during the downturn. When the market was at its lowest, her $200 was buying way more shares than it did at the peak. She was getting more ownership in America's greatest companies for the same amount of money. She was quite literally buying on sale. Fast forward 10 years to 2018. Steady Sarah's account isn't just back to $10,000. Thanks to the power of the recovery and all those bargain shares she bought during the panic, her portfolio has grown to a staggering amount, far beyond what it would have been if the crash never happened. And Panic Pete? He probably got back in a few years later, after the market had already made new all-time highs. He missed the entire recovery. He sold low and bought high, the exact opposite of the formula for success. He didn't just lock in a $3,000 loss. He forfeited tens of thousands of dollars in future gains. This isn't a fictional story. This is the reality for millions of people in every single market downturn in history. The market is the only store in the world where, when things go on a 30% off sale, people run out of the building screaming. Think about it logically. If you want to buy a new TV, and the one you want is suddenly half price, you rush to the store. If the gas station slashes its prices, you go fill up your tank. Yet when high-quality ownership stakes in the most profitable companies in the world go on sale, our first instinct is to sell the ones we already own. It makes no rational sense, but it's a powerful emotional response. The data is undeniable. The stock market has a perfect, undefeated record of recovering from every single crash, correction, and bear market in its history. It recovered from the Great Depression. It recovered from the crash of '87, the dot-com bubble of 2000, the financial crisis of 2008, and the sharp COVID-19 drop in 2020. Every single time it has gone on to reach new all-time highs. The single greatest threat to your long-term wealth isn't the market downturn itself. It's your reaction to it. Studies have shown that the vast majority of the market's long-term gains happen in just a few very powerful days, which are almost impossible to predict. And these best days often happen right after the very worst days, during periods of extreme fear and volatility. If you sell and are sitting on the sidelines, you will almost certainly miss that explosive rebound. Missing just the 10 best days of the market over a 20-year period can cut your total returns in half. Half, just from trying to be safe for 10 days. This is why the legendary investor Warren Buffett famously said his mantra is to be fearful when others are greedy, and greedy only when others are fearful. When everyone is euphoric and talking about how stocks can only go up, that's the time for caution. But when there is blood in the streets, when headlines are terrifying, and when everyone is panicking and selling, that's the moment of maximum opportunity. That's when fortunes are made. So what does this mean for you, a beginner? It means your most important job right now, before you even invest your first dollar, is to make a plan for how you will behave during your first market storm. Because it's not a matter of if it will happen, but when. Decide now that you will not be Panic Pete. Decide that you will be Steady Sarah. Understand that volatility is the price you pay for the incredible long-term returns the stock market offers. You don't get one without the other. A downturn is not the market taking your money. It's the market offering you the future at a discount. So you've hardened your mind. You're ready to face the fear and see a bear market as the ultimate Black Friday sale. You're ready to be greedy when others are fearful. But this raises a critical question. When everything is on sale, what exactly should you be buying? How do you distinguish the high-quality merchandise that's temporarily marked down from the cheap junk that's in the bargain bin for a reason, and might stay there forever? How do you build a shopping list of assets that are built to survive the storm and thrive in the recovery? That's the multi-trillion-dollar question, and it's the key to turning market chaos into personal wealth. So let's answer it. Forget trying to be a psychic. Forget trying to perfectly time the bottom of a market crash. The secret isn't in predicting the future. It's in preparing for it. Your goal isn't to build a speedboat that can only fly across calm water. Your goal is to build an unsinkable ship, a financial ark that can weather any storm and still be sailing when the sun comes out. This process starts not with a stock ticker but with a piece of paper. You need a plan, a blueprint. Think of yourself as an architect designing a building. You wouldn't just start throwing bricks and wood together. You design a foundation, then the frame, then the walls, all with a purpose. Your investment portfolio is that building. And the first, most important part of that blueprint is understanding the different types of building materials available to you. Let's start with the foundation. These are your bedrock assets. In the stock market, we call them blue chip stocks. The term comes from poker, where the blue chips are the most valuable. These are the Goliaths of the business world. Companies that are household names that have been around for decades, sometimes over a century. Think about companies whose products you use every single day without even thinking about it. The soap you use, the soda you drink, the software on your computer. These are companies like Johnson & Johnson, Procter & Gamble, Coca-Cola, or Microsoft. They are massive, stable, and often a little bit boring. And in the world of long-term investing, boring is beautiful. Why? Because their business is predictable. People don't stop brushing their teeth or washing their hands in a recession. Businesses don't suddenly stop using Microsoft Windows when the market gets choppy. These blue-chip companies have survived multiple wars, depressions, and market crashes. They have a proven track record of not just surviving but thriving. They also typically pay dividends. A dividend is like a thank you note from the company to you, its shareholder. It's a small portion of their profits paid out directly to you, usually every 3 months. During a market downturn when stock prices are falling, those dividend payments can feel like a lifeline, a steady stream of cash flow while you wait for the storm to pass. These are the heavy granite foundation stones of your portfolio. They might not double in price overnight, but they are incredibly unlikely to crumble to dust, either. Now, a foundation is essential, but a building is more than just a basement. You need walls, floors, a roof. You need growth. This brings us to our second category of building materials, growth stocks. If blue chips are the stable, predictable giants, growth stocks are the ambitious, fast-moving innovators. These are companies that are typically growing their revenue and earnings at a much faster rate than the rest of the market. Think of tech companies that are changing the way we live, or biotech firms on the verge of a medical breakthrough. They are the Teslas, the Nvidias, the Amazons of the world, at least in their earlier days. The key characteristic of a growth stock is that it reinvests every penny it makes back into the business. They're not focused on paying you a dividend right now, they're focused on world domination. They're hiring more engineers, building bigger factories, expanding into new countries. The bet you're making as an investor is that all this aggressive reinvestment will lead to massive growth in the future, which will then be reflected in a much, much higher stock price. This is where the potential for life-changing wealth is often found. Buying a company like Amazon in its early days could have turned a small investment into a fortune. But with great potential comes great risk. These companies are often younger, less established. Their future is not as certain. If their new product flops, if a competitor out-innovates them, or if the economy sours, their stock prices can fall dramatically faster and further than the blue chips. They are the steel beams that allow your building to soar into the sky, but they need to be supported by that solid foundation. An entire portfolio of nothing but speculative growth stocks isn't an ark. It's a kite in a hurricane. So we have our foundation of blue chips and our framework of growth stocks. What's next? We need to diversify. We need to build the walls, install the plumbing, and wire the electricity. This is where we talk about the single most powerful tool for a beginner investor, the exchange-traded fund or ETF. Imagine you want to invest in the US economy, but you don't know which company will be the next big winner. Should you buy Apple or Google, Ford or General Motors? It's a paralyzing amount of choice. An ETF solves this problem with one simple, elegant solution. Specifically, let's look at an S&P 500 ETF. The S&P 500 is simply a list of the 500 largest and most influential public companies in the United States. When you buy one share of an S&P 500 ETF, you are not buying one company. You are buying a tiny microscopic sliver of all 500 of them all at once in a single transaction. You instantly own a piece of Apple, Microsoft, Amazon, Johnson & Johnson, and 496 other companies. This is the magic of instant diversification. If one of those companies has a terrible year, it doesn't sink your portfolio. Why? Because it's just one out of 500. The success of the other 499 companies can cushion the blow. You are no longer betting on a single horse. You are betting on the entire race. You're betting on the long-term success and innovation of the American economy as a whole. For the vast majority of people, simply buying and holding an S&P 500 ETF over a long period of time is one of the most effective and proven strategies for building wealth. It's the ultimate set-it-and-forget-it building material. It automatically gives you a mix of blue chips and growth stocks, all bundled together. It's like buying a professionally designed, prefabricated wall system for your financial fortress. So now we have our shopping list categories: the stable blue chips for our foundation, the high potential growth stocks for our frame, and the diversified ETFs to build out the structure. But how do you actually choose which specific companies or funds to put on your list? This is where you have to become a detective. Not a financial analyst, a detective. Your job is to investigate the businesses behind the stock tickers. And the first rule is simple: invest in what you know. Look around your own life. What brands do you love? What products can you not live without? Is there a coffee shop you go to every morning? What brand of phone is in your pocket? What company made the car you drive? This is your starting point. If you are a loyal customer of a company, chances are millions of other people are too. That's a sign of a strong business. Once you have a list of companies you understand and use, dig a little deeper. Ask yourself a few simple questions. First, does this company have a durable competitive advantage? Legendary investor Warren Buffett calls this a moat. What protects this company from competitors? For Coca-Cola, it's their global brand recognition and distribution network. For Apple, it's their powerful ecosystem of hardware and software. A strong moat means the company can defend its profits for a long, long time. Second, is the company profitable? You don't need to be an accountant, but you can look up a company's basic financial statements for free online. Are they consistently making more money than they spend? Is their revenue growing over time? A history of profitability is a sign of a well-managed business. Third, is the leadership team trustworthy and competent? Read about the CEO. Do they have a clear vision for the future? Do they have a track record of success? You are not just buying a stock. You are becoming a part owner of a business, and you want to be in business with people you trust. By focusing on quality businesses that you understand, that have a strong moat and a history of profitability, you move from being a gambler to being a business owner. You're not just throwing darts at a board. You're carefully selecting the highest quality materials to build your financial future. This is the blueprint that turns market chaos into a predictable, methodical process of wealth creation. Now you have the knowledge to build your shopping list. You have the blueprint for your fortress. You know what kind of assets you're looking for. But knowing what to buy is only half the battle. How do you actually go out and buy it? How do you take the money from your bank account and turn it into a share of stock? What is a brokerage account and how do you even open one? What's the difference between a market order and a limit order? And which one should you use to avoid getting ripped off? That is the final practical step that turns you from a student into an investor, and it's exactly where we're going next. Alright, you've chosen your stocks, you've done the research, and you're staring at the buy button on your screen. This is the moment of truth. But right below that button, you see a drop-down menu with confusing terms like market order, limit order, and stop order. Clicking the wrong one can be the difference between a smart purchase and an instant, unnecessary loss. Let's demystify this right now. Think of it like buying a rare collectible online. First, you have the market order. A market order is you telling your broker, I want to buy this stock right now, at whatever the best available price is. It's the fastest and most certain way to have your order filled. If you want in, and you want in immediately, a market order guarantees it. But here's the catch. You don't have control over the exact price. For a massive, stable company like Apple or Microsoft, the price isn't going to whip around wildly in the half second it takes to fill your order. The price you see will be almost exactly the price you get. But what if you're buying a smaller, more volatile stock? Imagine a stock is trading, and you see the price listed as $100. You hit buy with a market order. But in the milliseconds it takes for your order to go through, a wave of other buyers comes in, and the best available price jumps to $101. Your order will be filled, but you just paid $1 more per share than you expected. This is called slippage. On a big order, that can add up fast. A market order prioritizes speed over price. Now let's talk about its smarter, more careful cousin, the limit order. A limit order is you telling your broker, I want to buy this stock, but I am not willing to pay more than a specific price. You set the limit. If the stock is trading at $100, you can set a limit order to buy at $99.50. Your order will now sit and wait. If the stock's price dips down to your price, your order gets filled. Boom, you got it at the price you wanted. The advantage is obvious. You have complete control. You will never overpay or get a nasty surprise from slippage. The disadvantage? Your order might never get filled. If the stock price takes off and never comes back down to your limit, you'll be left on the sidelines, watching the train leave the station without you. So which one should you use? For most long-term investors buying large, stable stocks, a market order is generally fine. The slippage will be minimal, if any. But if you're buying something more volatile, or if you're very particular about the price you pay, a limit order is your best friend. It puts you in the driver's seat. Now there's a third crucial type of order, but it's for selling and it's your number one defensive tool. It's called a stop-loss order. A stop-loss is an automated insurance policy against disaster. Let's say you buy a stock at $100. You're hoping it goes to $150, but you're terrified it might crash. You can place a stop-loss order at, say, $90. This order does nothing as long as the stock price is above $90. But if the stock price ever falls and hits $90, your stop-loss order automatically triggers and turns into a market order to sell. It gets you out of the position before the losses can get even worse. It's the eject button. It's what saves you from a stock falling from 90 down to 50 while you're at work or on vacation, unable to watch the market. It takes the emotion out of the decision to sell and protects your capital. It is one of the most powerful risk management tools a new investor has. Now that you know how to place an order, let's talk about where you do it. You don't just call up the New York Stock Exchange. You need to open a specific type of account called a brokerage account. Think of a brokerage account as a special bank account designed to hold stocks, bonds, and other investments instead of just cash. It's your personal gateway to the financial markets. Opening one is usually a simple online process, similar to opening a regular bank account. But not all brokerage accounts are created equal. They fall into two main categories that have massive implications for your taxes and your future wealth. First, you have the standard taxable brokerage account. Sometimes it's just called an individual account. It's the most flexible. You can put as much money in as you want whenever you want. You can take money out whenever you want. The catch? It's taxable. This means that when you sell an investment for a profit, that profit is considered income, and you have to pay capital gains taxes on it. If you receive dividends, you pay taxes on those too. It's straightforward, but the tax man always gets his cut. But then there's the second category, and this is where things get really powerful. These are tax-advantaged retirement accounts. You've probably heard the alphabet soup of names. 401k, IRA. These accounts are the government's way of giving you a massive incentive to save for your own future. They give you huge tax breaks in exchange for you agreeing to leave the money invested for the long term until retirement. Let's focus on the two most common ones you can open yourself: the traditional IRA and the Roth IRA. IRA stands for Individual Retirement Arrangement. A traditional IRA is built on the principle of tax-deferred growth. Here's the deal. Any money you contribute to a traditional IRA, up to a certain annual limit, can often be deducted from your income when you file your taxes. So, if you make $60,000 a year and you put $6,000 into a traditional IRA, you might only have to pay income tax on $54,000 for that year. It lowers your tax bill today. Your money then grows inside the account year after year, without you paying any taxes on the dividends or capital gains. The deferred part comes in retirement. When you start withdrawing the money, those withdrawals are treated as income and you pay taxes then. It's a pay the taxes later plan. Then you have its popular sibling, the Roth IRA. The Roth IRA flips the script completely. When you contribute money to a Roth IRA, you get no upfront tax deduction. You're contributing money that you've already paid taxes on. If you make $60,000 and contribute $6,000, you still pay taxes on the full $60,000. So what's the incredible advantage? The money grows completely 100% tax-free. And when you withdraw it in retirement, it is 100% tax-free. All of it. The initial contributions, the decades of growth, every last penny. You pay the taxes now so that your future retired self never has to pay a dime. Which one is better? It's one of the great financial debates. A simple way to think about it is, do you think your tax rate will be higher now while you're working or later when you're in retirement? If you think your tax rate is higher now, the traditional IRA's upfront deduction is very attractive. If you think your tax rate will be higher in the future, maybe because you expect your income to grow significantly, then paying the taxes now with a Roth IRA and enjoying tax-free growth forever is an unbelievably good deal. And we can't forget the king of employer-sponsored plans, the 401k. This is a retirement account offered by your job. It works a lot like a traditional IRA, where your contributions lower your taxable income today, and the money grows tax-deferred. But it has a secret weapon, a superpower that no other account has, the employer match. Many companies will offer to match your contributions up to a certain percentage. For example, they might say, We will match 100% of your contributions up to 3% of your salary. This is free money. It is an instant guaranteed 100% return on your investment. If you make $50,000 a year, and you contribute 3%, that's $1,500, your company will put an additional $1,500 into your account for you. There is no other investment on planet Earth that offers a guaranteed, instant 100% return. If your employer offers a match, contributing enough to get the full amount is almost always the single best first investment you can possibly make. So you've decided which account you need. Now you just have to pick a company to open it with. These are the brokers, firms like Fidelity, Charles Schwab, Vanguard, and newer app-based brokers. When you're choosing, there are a few key things to look for. First, fees. A decade ago, you used to pay a commission, maybe $5 or $10, every time you bought or sold a stock. Today, most major brokers offer zero commission trades for stocks and ETFs. Do not settle for anything less. Second, look for a platform that is easy for you to use. Is the website or app intuitive? Can you find what you're looking for? And finally, look at their educational resources and customer support. A good broker will have a library of articles and tools to help you learn. You've now walked the entire path. You understand what a stock is, how the market works, how to research a company, and now the nuts and bolts of how and where to place your first trade. You have the keys to the car. You've opened the account, you know the difference between a market and a limit order, and you're ready to go. But there's one final giant question looming. What do you actually buy? Do you just pick one or two companies you like and hope for the best? How do you build a collection of investments, a portfolio, that is strong enough to weather the inevitable market storms? How do you avoid the catastrophic mistake of putting all your eggs in one basket, only to watch that basket drop? The answer is a principle so powerful, yet so simple, that it's often overlooked in the mad dash for the next hot stock. It's the closest thing to a free lunch in investing. It's called diversification. And it's not just a strategy, it's your shield. It's the architectural blueprint for a portfolio that can bend in a hurricane, not break. Think of it like building a championship basketball team. If you recruited only 7-foot-tall centers, you'd dominate the rebound battle. But you'd get destroyed by a team of fast, agile guards who can shoot from anywhere. Your team is slow, one-dimensional, and vulnerable. A winning team needs specialists. A sharpshooter, a defensive powerhouse, a lightning-fast point guard, a dominant center. Each player has a different role, a different strength. When one is having an off night, others step up. They don't all succeed or fail at the exact same time. That, in its essence, is diversification. It's the art of not putting all your hopes on one type of player, or in our case, one type of investment. Let's travel back in time to the late 1990s. The dot-com boom. The internet was new, exciting, and it felt like a digital gold rush. Companies with .com in their name were seeing their stock prices explode, often without ever having turned a profit. Imagine an investor, let's call him Mike. Mike was smart, he saw the future, and he went all in. He poured his life savings into a handful of exciting tech stocks. Pets.com, Webvan, GeoCities. For a while he was a genius. His portfolio was doubling, then tripling. He felt invincible. Then the clock struck midnight on the year 2000. The bubble burst. The market realized that hype wasn't a substitute for profits. And Mike's can't-miss stocks? They didn't just fall. They evaporated. Pets.com, which had raised $82 million, went from IPO to liquidation in just 268 days. Mike's portfolio, his dream of early retirement, was wiped out. He had a team of all-star centers, and the game suddenly changed to a three-point shootout. Now consider another investor, Sarah. She also saw the promise of the internet, but she was a student of history. She put some of her money into tech, but she also owned shares in companies that make things people buy no matter what, companies like Procter & Gamble making toothpaste and diapers. She owned stock in Johnson & Johnson, a healthcare giant. She owned shares in banks. She even owned some boring, slow-growing utility companies. And crucially, she owned bonds, the financial equivalent of a defensive specialist. When the dot-com bubble burst, Sarah's portfolio took a hit. Her tech stocks got hammered, no doubt. But while tech was crashing, her consumer staples and healthcare stocks held up relatively well. People still needed to brush their teeth and see a doctor. Her bonds actually went up in value as panicked investors fled from stocks to safety. She felt the storm, but her ship didn't sink. She weathered it, and in the years that followed, her well-built portfolio recovered and soared to new heights. Mike bet on a few shooting stars. Sarah built a constellation. So how do we build a constellation? How do we practice this powerful art of diversification? It happens on several levels. The first and most important level is diversifying across asset classes. This is the big one. The main asset classes for most people are stocks and bonds. Stocks, as we've discussed, represent ownership in a company. They offer the highest potential for long-term growth, but they come with the most volatility. They are your offensive superstars. Bonds, on the other hand, are essentially loans you make to a government or a corporation. In return, they pay you interest. They generally offer lower returns than stocks, but they are far more stable. They are your reliable defense. Historically, stocks and bonds often have an inverse relationship. In times of economic fear when stocks are falling, investors often rush to the safety of high-quality government bonds, pushing their prices up. They act like a seesaw, providing balance to your portfolio. A mix of stocks and bonds is the foundational layer of diversification. But we can't stop there. The second level is diversifying within an asset class. Let's focus on stocks. If you just buy stocks but they are all tech companies, you're still making Mike's mistake from the dot-com bubble. You need to diversify across different sectors of the economy. Think about all the different kinds of businesses out there: technology, healthcare, financials, energy, industrials, consumer staples, the list goes on. Each of these sectors behaves differently depending on the economic environment. When oil prices are high, energy stocks might soar while transportation stocks, which use a lot of fuel, might struggle. During a recession, people might put off buying a new iPhone, hurting tech stocks, but they'll keep buying groceries, which helps consumer staples stocks. Spreading your investments across these sectors is like having players on your team who excel in different weather conditions. Next, you diversify by company size, or what Wall Street calls market capitalization. You have your large caps, the Goliaths like Apple, Amazon, and Microsoft. These are massive, stable, global companies. They are the bedrock of a portfolio. Then you have mid-caps, companies that are already successful but still have significant room to grow. And finally, you have small caps. These are the smaller, up-and-coming companies. They are riskier, many will fail, but the ones that succeed can provide explosive growth. A healthy portfolio has a mix of all three. The large caps provide stability, while the small and mid-caps provide a powerful engine for growth. And there's one more critical layer of stock diversification: geography. It's easy to have a home country bias and only invest in U.S. companies. The U.S. stock market is the largest and most dynamic in the world, but it's not the only one. There are incredible companies all over the globe. By investing in international markets, both in developed countries like Germany and Japan, and in emerging markets like India and Brazil, you add another layer of protection. Sometimes the U.S. economy might be in a slump while other parts of the world are booming. By diversifying geographically, you ensure that not all your success is tied to the fate of a single country's economy. Now I know what you're thinking. This sounds incredibly complicated. Am I supposed to go out and buy hundreds of different stocks from different sectors of different sizes from all over the world plus a bunch of different bonds? Who has the time or the money for that? This is where the single greatest invention for the modern beginner investor comes into play. The index fund, often packaged as an ETF or a mutual fund. Remember we talked about the S&P 500? It's an index that tracks the 500 largest companies in the US. Well, you can buy a fund like an ETF with the ticker symbol SPY or VOO that holds stock in all 500 of those companies. With one single purchase in one transaction, you are instantly diversified across all the major sectors of the US economy. You own a tiny slice of Apple, of Johnson & Johnson, of JP Morgan Chase, of ExxonMobil. You've instantly built a core portfolio that avoids the single stock risk that wiped out our friend Mike. Gets even better. You can buy a total stock market index fund like VTI. This one fund holds not just 500 stocks, but thousands of US stocks, large, mid, and small cap. It's a whole diversified US stock portfolio in a single ticker. Want to diversify internationally? You can buy a total international stock market index fund. Want to own bonds? You can buy a total bond market index fund. Using just 2 or 3 of these simple low-cost index funds, a beginner can build a globally diversified, multi-asset class portfolio that is more robust and safer than what even the wealthiest investors could have built just a few decades ago. This is the ultimate shortcut. It's the easy button for building that championship team. You don't have to scout every individual player. You can just buy the whole all-star league. So the fear of picking the wrong stock, the fear of putting your eggs in one basket and watching it fall, that fear can be managed. It can be tamed. The solution isn't to find a crystal ball. or to perfectly time the market. The solution is to build a structure so strong, so balanced, and so resilient that it doesn't need a crystal ball. It's designed to withstand the future, whatever it may bring. But now we have the final and perhaps most important piece of the puzzle. We know what a stock is. We know how the market works. We know how to analyze a company and how to build a diversified portfolio. But what do we do with it? How do we manage it over time? What is the actual day-to-day, year-to-year strategy that turns this knowledge into real life-changing wealth? How do you navigate the terrifying drops and the euphoric highs without letting your own human emotions sabotage your success? The answer is both simpler and harder than you think. It isn't a secret stock tip whispered in a back room. It isn't a complex algorithm that predicts the future. The strategy that builds real generational wealth is a strategy against the most dangerous person in your financial life. You. Specifically, the emotional, impulsive, short-sighted version of you that panics when the news turns red and gets greedy when it turns green. The entire game is about building a system so simple, so robust, that it protects your money from your own worst instincts. And that system has two core pillars. The first pillar is consistency. It's a concept called dollar-cost averaging, but let's call it what it really is, the automatic wealth machine. Imagine deciding you're going to invest $100. Not today, not tomorrow, but on the first of every single month for the next 30 years. Rain or shine, market up, market down. It doesn't matter. The transfer happens automatically from your bank account into your investment account, into that broad market index fund we talked about. What does this do? It surgically removes emotion from the equation. When the market is soaring and everyone is euphoric, your $100 buys you a few less shares. You're automatically preventing yourself from overpaying at the peak of the hype. But when the market crashes, when headlines are screaming about a recession and your stomach is in knots, your $100 is still there on schedule. And on those dark days, it becomes a superpower. It buys more shares than it did the month before. You are, automatically, without even thinking about it, buying low. Over decades, this simple, relentless consistency smooths out all the terrifying volatility. You end up paying an average price over time, capturing the market's long-term growth without ever having to guess the top or the bottom. You don't need to be a genius. You don't need to be brave. You just need to be automatic. You set it and you forget it. That is pillar one. The second pillar is time. It's the philosophy of buy and hold. But again, let's reframe it. Think of it as the gardener's approach. When you plant an oak tree, you don't dig up the acorn every morning to see if it's growing. You don't panic if there's a storm, or a drought, or a cold snap. You trust the process. You give it soil, water, and sunlight, and you let the most powerful force in the universe, compounding growth, do its work. Your investment in a broad market index fund is that acorn. Every time you panic sell during a downturn, you are ripping that sapling out of the ground. Every time you chase a hot stock tip, you're abandoning your oak tree to go plant a mystery seed you found on the internet. The winning strategy is to do the hardest thing possible in our culture of instant gratification. Nothing. You let it grow. For years. For decades. This is where we have to understand the single most important mental model for a successful investor. The two timelines. There's the market's timeline and there's your timeline. The market's timeline is measured in seconds, minutes, and days. It's what you see on the 24-hour news cycle. It's chaotic, noisy, and driven by fear and greed. A CEO says the wrong thing, a political event happens overseas, an inflation report is slightly off, and the market plunges or soars. If you live on the market's timeline, you will go insane. You will be whipsawed by emotion, buying high and selling low, convinced that every dip is the end of the world and every peak is a new paradise. The market's timeline is a casino, and in the short run, the house always wins. But then there's your timeline. Your timeline isn't measured in days. It's measured in years and decades. It's the time between today and your retirement. The time between today and when your kids go to college. The time between today and financial independence. On this timeline, the daily noise of the market fades into an irrelevant hum. Those terrifying 20% drops? On a 30-year chart, they look like tiny temporary blips on a relentless upward-sloping line. Your job as an investor is to force yourself to live on your timeline. When the market crashes, you don't ask, "What will happen by Friday?" You ask, "Will the most innovative and powerful companies in the world be more valuable as a whole 10 years from now than they are today?" The answer, historically, has always been a resounding yes. By combining these two pillars, the automatic wealth machine and the gardener's approach, you are fundamentally aligning yourself with your timeline. You are systematically buying assets over a long period and giving them a long period to grow. You're not trying to outsmart the market. You're just trying to own it, to participate in its inevitable long-term expansion fueled by human ingenuity and progress. And how do you survive the fear? How do you hold on when every fiber of your being is screaming, sell? You go back to the foundation. You remember that you didn't buy one single risky company. You bought an ETF. You own a tiny slice of hundreds of the best companies on earth. For you to lose everything, the entire American economy, Apple, Google, Amazon, Microsoft, and hundreds more would have to go to zero. All of them. Forever. If that happens, the cash in your pocket is worthless anyway. The cans of beans in your pantry are your new portfolio. That diversification is your shield. It's the logical armor that protects your emotional heart. It's what allows you to see a market crash not as a catastrophe, but as a sale. It's the clearance event you've been waiting for, and your automatic investment plan is already there, ready to scoop up the bargains. So let's bring this all home. After everything we've covered, from what a stock is to how the exchanges work, from dividends to diversification, what is the final, ultimate secret? It's this. The stock market is not a puzzle to be solved. It's a tool to be used. It is the single greatest wealth creation machine in human history, and for the first time ever, it's accessible to everyone. It's a mechanism for converting your labor today into freedom tomorrow. Every dollar you invest is a vote for your future self. It's a down payment on the freedom to choose your work, to spend time with your family, to travel, to pursue a passion, to retire with dignity. It's buying back your most precious, non-renewable resource, your time. The journey doesn't start with $1,000 or a hot stock tip. It starts with a decision to stop being a spectator in your own financial life and to become an owner. A decision to prioritize your future over your present comfort. A decision to believe that long-term optimism will triumph over short-term fear. Open the account. Set up the automatic transfer, even if it's just for $50 a month. Buy a single share of a total stock market index fund. And then do the hardest part. Go live your life. Let the system work. Let time and consistency do their magic. 10, 20, 30 years from now, you will look back not at the charts, not at the headlines, but at the life you built. And you will thank the person you are today for having the courage to take that first simple step. You have the knowledge. You have the tools. The rest is up to you.